Hello and welcome to Weekend Wisdom. Today we're going to discuss the difference, advantage, disadvantage of mutual funds versus ETFs, exchange traded funds. Dave Ramsey likes mutual funds. I disagree. So grab your cup of coffee, sit back, and let's get started. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget, click show more for additional information and links. And if you find this video of value, please do consider subscribing. So we've heard a lot about the difference between mutual funds and ETFs. As I was doing research for this, I came across this video from Dave Ramsey. He is the investment guru, wink, wink. Now, I want to share a couple thoughts here, but let's hear from Dave first.
Do I recommend good growth stock mutual funds that outperform the S&P above an S&P 500 index, ETF, or fund? Yes.
Okay, so I don't agree with him on a couple reasons. First, I don't know of any large cap mutual fund that has outperformed the S&P every single year for 10 straight years. I did the research, couldn't find it. He, of course, talks about buy and hold. I don't agree with that. You don't get in and out. Well, in order to add alpha to a portfolio, sometimes you do that, specifically with sectors. Now, as we're heading into the end of the cycle, you can look at gold as something that I haven't been in for several years, and now I am in. So don't agree there. Now, overall, you have to remember, I have to adhere to a compliance. Everybody's different. Everybody has different risk tolerance, personality. You're moderate, you're aggressive, right? Whatever the case might be. I'm speaking in generics today. So when you look at investment options today for the regular investor, you of course think of stocks, you think of bonds. From there, the creation of mutual funds, and then exchange traded funds. Now, ETFs. So you can buy a lot of different things within those, right? Individual equities that are in the healthcare sector. You can buy a healthcare mutual fund, a healthcare ETF. You can get alternatives like precious metals, gold, silver, REITs, etc. It's all available to you out there. So let's first look at mutual funds. Professionally managed pools of securities, okay, gives you nice diversification. The prospectus is going to spell out the strategy and investment focus. We'll touch on that one again. Benefits, drawbacks. Good diversification within there. You're able to not just have one stock, right? You can manage risk by owning multiple individual equities within this mutual fund. Professional management. Then you've got management fees, which the average, have linked below, okay, is about 1.45. I think that's high. You can get them between 0.85 and 1.25 in most cases. Tax consequences. If you're in an IRA or any type of retirement account, you're not worried about the taxes. Outside of that, you got to be careful because you can't control the tax consequences. We've had a lot of clients over the years get hit with capital gains. Now, let's look at ETFs. Very similar to mutual funds. They're traded on an exchange like a stock. Many are passively managed, which means they track an index. Advantage, disadvantage, we'll talk about that. Benefits, drawbacks, lower expenses. Today they're saying about, from the study I have below, about 0.25. Now I think that's high. Our large cap growth ETF is 0.08. Very inexpensive. You've got trading expenses here, so you have to be careful of that. Now, we use Fidelity, so you see those goofy commercials out there with various custodians saying $4.95. Not that expensive, but you also have what's called NTF, no ticket fee, okay? There's a large list of ETFs that don't have a ticket fee, and that's primarily what we use. So let's address fees out of the gates here as our first objection. $100,000 growing at 6% for 20 years. Pretty simple math, not simple, but I use my financial calculator. 327.13, good investment. Now, if you take the difference in cost between mutual funds and average ETFs, 1.45, 0.23, you're going to net 4.78 as your return, assuming that's the additional cost. Over 20 years, that comes out to 254, 429. A difference of 66,284. That's a big difference in expenses. That's also what we call lost opportunity costs. That's 66,000 that was not being invested. Next, address the idea of performance. In the last 10 years, okay? Actually, the 9th year in a row, fund managers underperformed indexing, okay? After 10 years, 85% have underperformed. 15 years, 92% of money managers have underperformed. How about liquidity? Well, when you sell a mutual fund, you could put in a trade for that day. It goes at the end of the day. As I mentioned earlier, ETFs trade like a stock, so you can get in and out during a day. Kind of important, I'll discuss that in a second. Some other items to consider. We talked about the prospectus. Well, when you look at a prospectus, be honest, how many of you actually read a prospectus, right? They're about this big. A large cap growth fund might say we can go 5%, small, mid, value. They give themselves a little bit of room, where on the ETF, they're pure. So if you want a large cap growth fund, you're getting that. So from my perspective, I really like that because I know exactly what I'm getting. So that's very important. Volume, you can really track volume on the ETF. So why is that important? You can see where money's flowing in and out over a period of time, just like a stock. I use that volume, price, volatility to get in and out of stocks and ETFs. Volatility index continues to hug that 15 line. I'm not buying until we break, and I mean break below that. You can also use technical analysis. That's the charts. I use them all the time. We'll have a link to our latest video here on that. So it allows me to look, are we above, below 50-day? What's the strength, relative strength, momentum? What is the volatility on that particular ETF? These are all good things to have when making a decision. So for conclusion, I don't agree with Dave Ramsey. Understand he has programs he sells. That's how he gets paid. He's got a certain way. I'm not going to get into all that. You can Google that. But to me, an ETF is a better option because I've got liquidity, which allows me to move when I need to move, rebalance easier. Fees, we showed that big time. And pure. I want to know what I'm buying from my clients. I think it's real important when building an asset allocation model. As always, thanks for watching. Any questions, concerns, comment below. This is Michael Loftus for Wealth and Wisdom TV.